When you decide to enter into a trade in the Forex market, you will not be paying the exact price that your chosen pair is trading at that very moment. There is always an ask and a bid price listed, and those are the prices that you will be paying. The ask price is always a little higher than the bid price. Now, you will be paying the bid price if you are placing a buy order, and you will be paying the ask price if you are placing a sell order. Now, the bid and the ask prices are always an equal distance away from where current price action is sitting for that pair at that moment. So if the ask price is at 1 pip away from the current, trading price of your pair, then the bid price is also going to be, 1 pip away from where price action is trading for that pair at that moment. Now, the difference between the ask and the bid price is called the spread, and the spread goes directly to the broker. Now, they are not the same amount for every broker, so that is something you'll need to research for your main trading pairs before signing up with any brokerage firm. However, you'll pretty much find that spreads are very competitive when it comes to the largest trading pairs. They won't differ real widely. Spreads are mostly driven by how much trading volume is in the market at that time for that specific pair. This means that spreads fluctuate all throughout the day and the night. For instance, like some pairs, spreads can be lower during the New York session than they are during the Asian session due to the trading volume being higher during the New York trading hours. Spreads also range between small fractions on a pip of some of the most commonly traded pairs and up to hundreds of pips for some of the exotics. Before setting up any trade, you always need to keep in mind where the spreads tend to range for that pair. Because if your spread is 15 pips and you're only running a 20 pip stop loss, your trade can be stopped out if price action moved even 5 pips away from your original entry from your trade bias, even if overall it would have been a winning trade simply because the spread was way too wide for your stop loss. So you want to be aware of kind of where those spreads tend to range for your pairs. Also, keep in mind that every time you enter a trade, you will be entering at a deficit of the spread. For instance, if the spread is 3 pips and you enter a trade, you are entering at a -3 pip starting point because of the spread. For scalping or strategies where you're taking profits at 10 or 15 pips or less, broker spreads are really even more important when it comes to your stop losses and your spreads upon your trade entry. When you're looking at the bid and ask prices, let's just kind of look on a live market. Right now, price is actually trading right here at 86.087. But if you were to place a sell order, even though price is trading right here where my crosshairs are, you're going to be paying this 86.089 to enter a sell order. If you enter a buy order, even though price is trading right here at my crosshairs, you're going to be paying 86.074. So you're always starting in a deficit. That's the spread, and that's the amount that goes to the broker. So in just looking right here that this is where price is trading, this is the ask and the bid price. Right here, if I just place a sell order right where everything sits, you can see where the stop loss is, where the entry is, and it's down here, but where the take profit is on this order. And so you didn't pay exactly where price was trading right then. You had the bid or the ask price. I'll just show you real quick how you're entering in at a deficit. So right now, if you look at your positions that are open right now, we placed a $100 trade just a second ago, and you open up at -$11 at this $100 trade. And so you're just you're always opening up not at zero, but at a negative because you're paying the bid or the ask price, just depending on what your bias is.